Bloomberg Audio Studios. Podcasts, radio, news.
Just before we get started, one thing I want to mention to you. You may remember that last year we recorded some of our podcasts at Panmure House in Edinburgh as part of the Edinburgh Fringe. We are doing that again this year. The show is called The Butcher, the Brewer, the Baker in Merryn Somerset Webb. I will be discussing all sorts of exciting political and economic things with a variety of fascinating guests. Tickets are on sale now at the Fringe website. It's on the 22nd, 23rd and 24th of August, and we very much hope that we will see you there. Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. Now, there is a growing sense among global investors that it is time to start looking outside the US for your equity investments at least. And we have talked about this a lot on the show. We're calling it, as are others, the Great Rotation, where capital that once flowed almost entirely to the US, and we've looked at the numbers on that over the last few months, is now beginning to move elsewhere. And in particular, we've been talking about Europe. The dollar is softening, valuations in Europe are cheap, the geopolitical landscape is all over the place. It no longer makes sense to ignore the markets in Europe. Institutions are responding. There is a lot going on, and we are going to talk about some of the things that are happening in markets globally and particularly in Europe with this week's guest, who is Stéphane Boujnah, who is the CEO of Euronex and the chairman of its managing board. Welcome, Stéphane. Thank you so much for joining us today.
Thank you for having me.
Before we start talking about markets, tell us a little bit about Euronex, right? It's the biggest exchange operator in Europe. You've been through a series of acquisitions. You own quite a lot of stock markets now. Tell us a little bit about what you do.
Well, Euronex is a company that was founded 25 years ago, that went through all sorts of bumpy times, was re-IPO'd after 7 complicated years under the ownership of New York Stock Exchange. It was re-IPO'd in 2014 for a market cap of 1.4 billion euro. Today, it's a company with a market cap between 15 and 16 billion euro, so it's much larger. And this success is the outcome of a significant work in terms of consolidating market infrastructure across Europe. So today, we consolidate and we operate within a single liquidity pool, a single order book, a single technology platform, the market infrastructures of Paris, Amsterdam, Brussels, Lisbon, and in 2017-18, we bought the Irish Stock Exchange. In 2019, we bought Oslo Børs VPS in Norway. In 2020, we bought the VP Securities, the CSDs of Copenhagen. In 2020 and 21, we bought the Borsa Italiana Group in Milan. And we are in the process for a possible acquisition of the Hellenic Exchange, of the Athens Stock Exchange. So a significant part of our business is about consolidating market infrastructure in Europe. It's not what we do only, but this is very important. And for UK audience, it's important to bear in mind that this single liquidity pool in Europe is now twice larger, approximately, than the London Stock Exchange. Every day, we trade around 10 to 12 billion euro of on the single integrated market of Euronex, and the aggregate market capitalizations of companies listed on the single market of Euronex is around 7 trillion euro, which is approximately twice the size of the London Stock Exchange aggregate market capitalization. So this is, for equities, for sure, the leading platform in Europe. Obviously, alongside that, we are very active in soft commodities, in agricultural commodities, in electricity trading, in fixed income trading, in particular in sovereign debt trading, but also in forex trading in London, Singapore, and New York, and for sure in all sorts of diversified services, corporate solutions, etc. So historically, stock exchange business, a single integrated stock exchange business, the largest player in equities in Europe, and a diversified business now.
Okay, brilliant. Well, obviously a lot of growth under your tenure. I hope you have shares.
I have some shares, but it's a listed company. So I make revenue, I don't make capital.
Of course. Okay. Well, I enjoyed that talk about how everything is much bigger than London. But of course, we must bear in mind that if you bring together the markets of several large economies, that market will definitely be bigger than the market of a single economy. And I will just point out that if you look at the Global Financial Centers Index, London still always comes out second. New York, London, Hong Kong, and the first financial center that even makes it onto that list is Frankfurt at number 11. So, we still have something going for us here.
No, that's for sure. And I love your country, and we have more than 100 people working there, and we have more employees today than before Brexit. My point is just to highlight the fact that when it comes to equity market, you need to compare apples with apples, and you have to compare the London Stock Exchange equity market with the alternative, which is not a location, a collection of locations, but which is a single integrated market. That's why we have much more international IPOs and much more IPOs than anywhere else in Europe, because we operate a single integrated European market. And size does matter when it comes to liquidity.
All right, I'll give you that. So you will have oversight then of pretty much everything happening across European equity markets. And so let's talk about the extent to which you are seeing this great rotation, capital leaving the US for European markets.
I don't want to repeat things that are probably well known by your audience, but there was a trend that started at the end of last year before the Trump moment, which was all about the US is expensive and Europe is cheap. The concept of valuation multiples getting extremely expensive in the US and valuation multiples in Europe not being justified by the prospects of the company, that was part of a process that initiated some form of reallocation of assets before January. Then, so that's what we could characterize as a rotation. What has happened since January is different. This is a massive global reallocation of trust. It's not a rotation. It's a global reallocation of trust. Because slowly, the investors realize that the US, as we knew it, is not recognizable. And that's why trust is being reallocated across the globe, across asset classes, by the way. Everyone talks about equity, but what is happening on the sovereign debt world is absolutely fascinating. So what is happening? On the equity side, as mine, the perception is that weeks after weeks, the US are accumulating all the features of what used to be called, when we were young and slim, an emerging market. The US is becoming an emerging market in every respect. The rule of law is dislocating, and that's one feature of an emerging market, usually. The volatility of decision-making of the leadership is there. The leadership is appointing very strange people in very senior positions. The conceptual bedrock of decisions is debatable. You don't recognize whether they do things that are good for them or what's in it for themselves. So the lack of obvious rationality behind decisions is also one feature of an emerging market. And what is fascinating is the fear in their eyes, the fact that they feel intimidated and they don't want to confront the leadership because there is a level of brutality in interactions with the leadership that is again, one specificity of an emerging market. So it's okay to do business in the emerging market. It's fine. You just need a higher return, quicker returns, and slower valuations. And this is what is happening. So behind the global reallocation of trust, there is an element of, okay, we understand the world, this environment precisely than before. There is a much stronger level of uncertainty and unpredictability. So I need lower valuations.
But nonetheless, the US equity market hits new high after new high.
No, but I'm telling you what is happening. As you know, the US valuation requires more than everywhere else a clean distinction between the Magnificent Seven and the others. And that's a permanent test that needs to be applied before making across the line comments about the level of markets. What I'm telling you is that behind the recovery, the stronger recovery of European markets, in particular continental European markets, versus the US, there is a number of US companies who tell us we can't do proper valuation of US industrial companies because we don't know how to block the basic metrics. What is going to be the inflation? What is going to be the interest rates? What is going to be the exchange rate? What is going to be the cost of inputs? What is going to be the probability, the feasibility of export? For any industrial company, many of those factors are open in the air because of the volatility of the current tariff war. So this is there. Now, on the debt side, clearly, you can't add so much debt and so much deficit without some form of reassessment of the pricing of the yield. And that's what the rest of the world is doing. So we are not in a situation where the world is massively shorting US debt to massively be long on European equity or in European debt. We are in a world where people don't reinvest, don't roll out when they redeem some assets. They are just switching quietly. So that's what is behind the great rotation. A part of it is sustainable, basically the reallocation of multiples. I mean, clearly the current valuation of the US market remains overvalued in the eyes of many investors. A part is just going to stabilize when the dust settles in the US, if and when. I think it's not a market correction. It's not even a rotation of assets. It's a fundamental reallocation of trust across the planet. I was in Asia a few days ago and in the Gulf a few months ago, and people are telling us, show us assets in euro because we want to diversify away from US because we have been used to be too concentrated on US assets. I've seen some people in Asia telling me, okay, we were exposed some large funds. We had a strategic allocation of 5% to Europe only. We want to move to 10%. Well, 10% is not a lot at global level, but it's just double of what they were allocating to Europe.
It's interesting, though, isn't it? That from the point of view of non-EU, non-US investors, you could say that the EU and certainly independent in different countries inside the EU are remarkably politically volatile as well. And I mean, the debt situation in France is appalling, on a par with America's. So it's more the level of trust in the US coming down to meet the level of trust in European assets rather than anything else.
One guy told me Europe today is perceived as a large Switzerland. It's not like everyone is getting fascinated about the growth prospects of European economies or the political stability or the points you are making about the political fragmentation in the French landscape is there. It's just the feeling that the institutional framework is stable and predictable. You know where you are. You know how to make assumptions, and you know the bandwidth on things where your business is going to be operated. So the amount of uncertainty is much more reduced. So you have probably a lower yield, but much lower risk. Hence, a better return than a situation with a yield that can be strong, but a significant volatility and uncertainty. So for certain investors, and that leads to other decisions that are happening below the screen. I've met a CEO of a large European company who is telling me that he's repatriating physical assets from the US that were custodied by large custodians. They don't want to run the risk of weaponization of assets under custody in the US.
Interesting. When you say physical assets in the US, do you mean gold?
No, not necessarily gold. Gold is a very important debate, and you've been made aware of the rumors about some central banks in the European Union decided to repatriate some gold, and as you know, they are not public on those decisions, but they did not deny the rumor. But I'm talking about securities, shares, or instruments, also that can be custodian and by US under custody of some US institutions and that are being repatriated. So these things happen. And so that's why I think it's very scary is that people are doing things below the radar and these things are happening. A part of it translates into higher valuation. A part of the higher valuation in Europe, in relative terms, is driven by a renewed appetite in relative terms vis-a-vis the US. And as you rightly pointed out, in relative terms vis-a-vis the US, it's not like all of a sudden the growth prospects of Europe are appearing significantly rosier. It's just that Europe appears much, much more predictable.
Okay. The other part of this great rotation, well, there's two bits to talk about. One, we'll come back to maybe to growth in Europe, but the other part of the great rotation is also the patriotic side of it. So, for example, you've probably been following the debate in the UK about the extent to which pension funds, for example, should be obliged to invest in UK assets and the extent to which people who have money inside a tax wrapper in the UK, an ISA or whatever, should be obliged to invest in UK assets. And certainly this is something that has come up in France, this idea that it's ridiculous to be sending a productive capital of European countries to be invested in the US. And the sense that there should be some way to actively encourage, possibly even mandate, the investing of European savers' money inside the European Union as opposed to outside.
One preliminary comment and then the fundamental answer to your question. The preliminary comment is that it's very different to address the issue in the UK and in Europe. Because within the European Union, you can build relatively diversified portfolios in a block of 450 million people with the second largest economy in the planet. You can build a diversified portfolio across Europe. And since we cannot have, it's forbidden by European law, any forced allocation by country in any way whatsoever, then it could make sense at some point of time to consider incentives to invest some assets within the European Union without harming reasonable diversification. I think it is more complicated in the UK just because the UK economy is smaller and therefore any forced or incentivized allocation within the UK economy would lead to a disproportionate concentration that you don't get when you can invest across Europe. So that's a metastasis of Brexit or contradiction of Brexit. You can take back control, but the more you reduce the size of the village, the more you end up into forced, incestuous relationships because the pool of assets is too small.
Oh, I don't think the expectation was ever to ask anyone to put 100% of their assets in the UK, but I take the diversification argument.
No, but that's why the debate is slightly different. But now, because fundamentally more, it's true that both in the UK and in the US, we are generating significant savings, more savings in the European continent than in the UK. You guys in the UK love debt more than we do in the continent. So it's about between 13 and 18% of disposable income which is saved in Europe. I don't know what are the numbers in the UK. It should probably slightly around that or maybe slightly lower. And most of these savings is exported in the form of investment in the US. Up until there, it makes perfect sense because the best thing you could do with your saving was to allocate a part of your savings to projects where there is growth. And for the past 10 years, there was growth in the US. So it was making perfect sense in the search of yield to invest in the US. What became complicated is that when you combine the export of European savings with the strength of the US equity markets, you get to the formation of huge institutions. I mean, very often people associate the success of the US economy to the innovation, the technology, energy, etc. And that's true. Palo Alto, entrepreneurship, innovation, technology is one leg of the US success. The other leg that nobody talks about enough is the fact that the success of the US economy is driven by the size of their pension savings. For everyone in the US, if you want to have some income when you are old, you need to buy shares when you are young. In Europe, when you want to have some income when you are old, you just need to hope that people around you continue to pay taxes and social contributions. So you get to a situation with some nuances in the UK, but with the strength of your corporate pension fund.
Well, and also our auto-enrollment system. So, we have a new vast sum of capital rising up in our auto-enrollment system in the DC system.
By and large, the main difference between allocation of savings in the US and in Europe is the dominance of pension savings in the US that feeds long-term deferred liquidity instruments that are equity. And that what has created large companies like large players like BlackRock, Vanguard, Fidelity, etc. So those guys then themselves work on diversification or strategic allocation and look at Europe. So they manage a mixed pool of European savings exported to the US, local savings collected from US households, and this combined pool is partly invested in Europe. So that's why we have this paradox of the US players pumping a lot of savings from Europe and exporting a lot of equity within European companies.
Yeah, and then you have European savings kept in cash.
Absolutely, because we don't have the incentives to prepare for retirement with instruments that produce a better yield than cash, and then which go with deferred liquidity that you don't have with cash.
So if you wanted to incentivize European savers to invest, you should slash the size of the welfare state significantly so they're forced into it.
I would not go that far. That's the intellectually pure conclusion. But clearly, you should have a set of incentives, and some countries have it. And by the way, because the European Union, these pension arrangements are member states level. The UK, when it was part of the European Union, had the most sophisticated and advanced pension fund schemes, mainly corporate.
Well, we also had one of the highest rates of pension savings to GDP, which some people suggested there was a jolly good reason to leave in a hurry.
My point is that it was not incompatible with being member of the European Union. So since you left, we have other countries with a significant share of GDP in pensions funds, like Sweden, Netherlands, and Denmark. So member states have to address exactly the point you are making, which is, if I incentivize people to invest in pension funds, does it create a risk of pumping out resources for the pay-as-you-go state egalitarian system? That's the first political problem that every country has to address. There is another one which is less visible, but which is very fundamental, is that most European countries, not all of them, but many of them, it's not for the case in Sweden, but it's the case of Italy, Spain, France, have incentive, directly or indirectly, to incentivize people to buy sovereign debt. So the liquidity of the sovereign debt is usually encouraged by all sorts of tax incentives. Now, clearly, the reason why people keep cash or quasi-cash is because they are offered protected liquidity and protected yield instruments that go to govies. If you want people to swap their investment from govies to long-term equity, then you reduce mechanically somehow the liquidity of the sovereign debt. And governments have to make an arbitrage. Do they want to sponsor or to support or to encourage the liquidity of their own debt? Or do they want to encourage the equity funding and the growth of their companies? And that, on one case, if you want to encourage liquidity, the equity funding, the risk-taking capabilities of your companies, you encourage pension funds and long-term equity investment. If you want to facilitate the liquidity of your debt, then you put all sorts of incentives for people to buy govies. And this, another debate, the arbitrage between equity for companies or money for govies to finance debt, which is complementary to the first debate, which is pensions, individual saving versus statutory solidarity schemes.
Part of what's happening as a result of this conversation is this promotion of the European Savings and Investment Union, or what was the European Capital Markets Union. And that is going to work to do exactly as you say, to take all this cash and deploy it one way or another into European equities in the main. Is that what that's designed to do? And that should be another boost to European equities across the board, that inflow of capital.
Yeah, I mean, the reason why there's a waking up is there are multiple reasons why this saving investment union is going to happen. Since we are talking to a UK audience, I really want to explain why we are where we are and why the capital market union stopped and did not deliver for the past 10 years. The capital market union was a very smart idea of Jonathan Hill when he was the UK commissioner at the European Union. Mm-hmm. And at that time, the idea was very simple, was to accelerate the integration of European capital markets because it was going to be good for Europe, but it was going to become excellent for London because at that time, London was the largest financial center of the European Union. And it was making plenty of sense. I mean, the agricultural common policy in the 60s and 70s was all about building food sovereignty for Europe. And it was a French project because it was good for Europe and it was good for France. So you achieve a lot in Europe when there is a country that is a leader. Now, when the UK people, the British people decided to leave the EU and Jonathan Hill left the Commission, the leadership to build the capital market union evaporated. And honestly, for the past 10 years or so, since, let's say, the referendum of June 16 and the departure of the UK, there was no leader or sponsor of the project. And since the UK has decided that London would not be anymore the largest financial center of the European Union, but would become the largest financial center of the United Kingdom, the situation has been frozen. We are now in a situation which is totally different. The Draghi report, the Letta report, the sort of various wake-up calls about the fact that we need to finance equity in Europe, long-term project, climate change, defense, rearmament, all that requires a lot of equity, is pushing for an acceleration of the capital market union. And the reassessment of priorities is ongoing. And I do believe that we are going to deliver very quickly in various levels. Single supervision will happen. And that will be a game changer because when rules are similar across Europe now as they are, they remain different. So the only way to have same rules is to go for same interpretation of same rules through a single supervision. And that will happen. Clearly, the new assessment of what are the best incentives for pension funds, even if it remains a member state level, there will be some form of harmonization. And you should expect that the combination of member states' decisions with the European decision is going to create a situation where 5 years from now, the amount of pension will be massively more important than it is today. Actually, the German government has announced that they will launch a program. Under the previous government, they had already launched it and it was interrupted by the snap elections and it is being renewed by the new coalition. So you will have significant progress. It's like everything in Europe, it is slow because that's the nature of our project. We are better at reacting than at acting. But even if it is slow, it will happen. The European Union is a diesel car. So it takes time to get to full speed. But, Schengen, Erasmus, the euro currency. So I remember all the bashing about the euro during the great financial crisis 10 years ago. And we made it through. And I think the saving investment union will happen. But it's going to be complicated because I was referring to the UK leadership that disappeared. In Europe, you have some countries that make finance, and you have some countries that just buy finance. The point here is that we are at a moment where the momentum for the capital market union is definitely accelerating. I spent a lot of time in Brussels. I can tell you that the dynamic, the ownership by political leaders to make it happen. Mr. Merz in Germany, Mr. Merz spent many years of his life at BlackRock and many years of his life in the board of Deutsche Börse. The leader of Germany is very personally focused on financial issues. The same in France, the same in the Netherlands. So we are on the right track to make it happen.
Okay, and Stéphane, is one of the motivations here, and possibly from Germany in particular, is one of the motivations to produce a pool of cash available for spending on defense. One of the things that you said recently is that we should look at ESG in the traditional sense, that we should also, look at it in a different way and say ESG, and we've talked about this a lot on this podcast as well. ESG should now stand for energy security geostrategy. So a modern definition that is also about well-being, long-term well-being of a population. So one of the motivations behind providing this pool of cash is that it does go into defense.
Absolutely. I mean, that's a point on for which the alignment with the UK is essential and is perfect. I mean, clearly, in the environment we are facing, the countries that have a tradition of building strength, of projecting strength, of managing strength, is quite something common between the UK and a few countries like France, Norway, Sweden, etc. So I think we are all facing the same issues. Armament projects have a very low return on investment, a very low return on equity. So you need equity to fund this project. You need money for the governments to pay as clients. So they will need some debt issue will have to be addressed, or some public finance issues will have to be addressed on the client side. But on the maker side, on the supplier side, if you want to accelerate production capabilities, if you want to accelerate innovation, if you want to consolidate the players, you need more equity. So that's why this concept of investing in the European sovereignty for energy security and geostrategy is getting huge tractions with investors.
Okay. Stéphane, we are running out of time, so can I just ask you a couple of quick questions? First one being, is AI impacting your business at all yet? Are you finding that the way you employ and the way that you manage is changing as a result of being able to use it? Yes.
Yes, it does. Mainly on, like many companies, mainly on the cost side, where we are reassessing many of our workflows and processes through AIs. It's not going to cure cancer. It's not going to do everything. It's not magic. So on the revenue side, we are more cautious because many of the things we are not transformed by AI. But on the cost side, on the process side, definitely has a very significant impact.
And how do you feel about crypto as an asset class?
Skepticism. This is typically a situation where I prefer to be late rather than be wrong.
Fair enough.
I prefer the rest of the world to play with matches and get to a situation where they are comfortable with these new instruments. I believe that exchanges, market infrastructures are full of trust from the general public. And I just don't want to be the shop around the corner with the window the day everyone realizes that there is an issue. There are too much assumptions, religious assumptions behind this asset class that lead me to be skeptical for the moment.
Fair enough. And finally, what are you reading at the moment?
It's a good question because I have one hobby only in my life. I read one history book per week. So I read a book from an Australian writer, and I read in French because it's more pleasant for me. His name is Clark. He has published a few months ago a book called 1848, which is all about the consolidation of the revolutionary trends or movements across Europe in 1848.
Yeah. Brilliant. Thank you very much. I've been reading Clark's book as well, by the way, and I think everyone should read it at the moment. It's quite, it resonates quite well with our current world.
Yes.
Thank you very much indeed for joining us.
Thank you.
Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm at MerrynSW, and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It's produced by Sam Asadi, Moses Anda, Mantala Amadi. Sound designed by Kelly Gary. And special thanks, of course, as always, to Stéphane Boujnah.